Hey guys, welcome to Rich to Rich's Intro to Options. And I created this class for people who really don't know anything about options, but I'm really struggling with looking at what I see on my slides, which is the the educated, thing about options, right? Like I want to break it down in my terms what options has been to me as a trader, okay? So, as I've explained on TikTok and in various places, options trading has been really, really exciting. I honestly think that I would do better as an option swing trader or a leap trader because options we do have where you can do it day to day, but the day to day takes really precise skill that sometimes newbies don't have down pat. And that's where we start to get clapped in the market when we're doing zero DTE, 0 days till expirations. And we're trying to do SPX and tickers that everyone else is doing, but we haven't been in the market long enough because there's a section that we're going to cover in here that talks about the Greeks. It talks about Greeks, and it's a funny thing. A lot of people don't even really know about Greeks when choosing contracts. I'll be honest with you, at times I still don't look at Greeks when choosing contracts, and I've seen it not work the best for me here. And so tonight's class, I'm just gonna break those down one more time. But all in all, with options, I know that I'm doing one of two things. I am looking at the market on a whole, like an entire level. I'm looking at different time frames before I even take an options contract. So this is my version of what you should learn tonight. I am looking at a particular ticker because honestly, as a newbie, we need to master our tickers. I can't stress this enough. The way you guys need to find your ticker and master it is like it's so important, my love. So if you don't have a ticker that you trade every day consistently, day in and day out, if you could give me 21 days after this chat on a ticker, I would love you long time. Do you hear me? Because you'll understand how that ticker moves. You'll understand how deep the drawbacks could be, or the drawdowns is what we call them. Like like when we're dropping, and then all of a sudden that big green candle prints, and we're like, get out, close it, close it, close it, close it, and then it continues to go in the down direction. Yeah, that. You will understand that when you have consistency with a ticker. So the market requires that you have a high level of consistency, of accuracy, of like the ability to analyze things and then to enter in on the right time frame, at the right cue, or at the I would say at the right level, because I posted a video about that tonight, where he says, the big traders, the big money makers for companies, they don't enter, at a weird spot. They enter at key levels. And that just changed like my whole, concept. So we're going to really drive that. Knowing what level is a good level to enter in on IWM. You can't just go, "Ooh, IWM has this big real long red candle. I'm going to jump in and I'm going to get in a put," because IWM will literally, the moment you get in, it goes skirt and literally draw back that entire candle. The entire candle. You're like, no, what? So consistency with the ticker will be so helpful. And I want you to think about that as I begin to read the rest of this tonight. Okay. So welcome to Intro to Options Trading with Trader Bay. I'm Danny, and we're going to break down the foundation of options trading in a way that makes sense. So by the end of this class, you know what they are, how they move, and how to trade them, instead of just being in the market and, not knowing anything, right? So I created this class because options are a powerful tool, but they're often misunderstood, coming from a person who misunderstood and sometimes will still misunderstand them. Many traders overcomplicate options and treat them like lottery tickets. Oh my gosh, y'all. Especially on SPX. People be quick to go SPX lotto. That SPX will eat up your lotto so quick it'll make your head spin. You'll drop like $30, like, yeah, this is gonna go good. And them $30 will be gone in the next 10 minutes. You'll be at zero, literally. And it's funny because if you don't know anything else about options, tonight I'm gonna break it down. The moment that you're out of profit on your options, theta is working against you. The moment you're out of profit. So when you see red on your option, you gotta have that momentum. You gotta have that precision. You have to know that this is truly the direction that your stock is going and not you just getting in on a hunch, because every minute that goes by in red, theta is taking cents away from you. So I'll talk more about that as we go further down, how I experienced that. And man, that was the worst. Okay. So you're going to learn about, the Greeks and how they affect pricing and how I use structure and psychology together to trade. So, oh God, these boring. Ugh. An option is a financial contract that gives you the right but not the obligation to buy or sell a stock at a specific price. You're paying for the control but not the ownership. Each options contract usually controls 100 shares of the underlying stock. Options are flexible, time based tools, and they represent probability and opportunity. Squash all that. Like, what's an option? If I had to break it down in Danny terms, an option is an extension of that main indice. Okay, so we have like IWM, she's an extension of Russell 2000. We have NDX and QQQ, that's an extension of NASDAQ. We have SPY and SPX and XSP, that's an extension of the S&P 500. And then we have DIA, which is an extension of the Dow Jones. Okay, so that's how I look at them. Those are the options. Boom is there. And it says that typically an option controls 100 shares of the underlying stock, and that is very true. And it's funny because I had someone explain to me that their option expired. I've never been a part of that, but her option had expired, and Robinhood tried to exercise her to pay them $100 because it expired at $1. Like, it literally went to expiration, but it still had $1 left. And so they wanted $100 from her, and she said she wasn't going to pay. So I want you guys to understand that you literally could be obligated to pay something if your option expires and you still have it in your possession and it still has a little bit of value to it. If it has $2 value, $3 value, they gonna exercise you to do that times 100. Okay, and then those stocks then belong to you. Right now options don't belong to us. We're exchanging them through the market, but they're not ours. So I want y'all to understand that. Okay, so there's only two types of options. There's calls and puts. Okay, so calls are buy in the futures market. That's the buy, that's the green, that's the bulls. And then we got puts, that's the red, that's the bears, that's when the market's going down. Okay, so call gives you the right to buy when it's bullish. A put gives you the right to sell when it's bearish. Call profits when the price rises and puts profit when it falls. So today we would have been in puts all day. It wasn't a not nary a part of the day that you should have been in a call. If you happen to have gotten in a call today because you got faked out by that green candle, guess what? Don't worry. I teach you more about that in Trader Bay method. I'm going to teach you more about it tomorrow in futures class. That we had not reached the 50% of the fair value, so there was no reason why y'all should have been in no call. And that's how some people got clapped up, but we're not going to hark on that, okay? We today was straight puts. It was straight red, okay? Now, the funny thing about it is, if you did not catch it at the correct initial move and push, you got clapped today still. So you would have gotten into your cues or your SPY or whatever the case is, and we kept going back and forth. We would go push down a little bit, pull up a little bit, push down a little bit, pull up a little bit. And that's where theta could get some people caught up. And so where you should have maybe came out of your contract today plus 50 plus 100, you might have only came out plus 25 plus 10, because literally the market was like, it was fighting. Like, we literally had a nice little fight today. There were a few parts in there where if you had been holding your contract with consistency and persistency, we would have dropped and then it would have put you in profit, and then the drawbacks further down wouldn't have even bothered you. And that's the importance of timing your options and getting in on your contracts at the right time. Because if you get in during chop, you never really get a chance to profit like you should. You have to be there at that initial move, that initial break, and the retest of it, and then be ready. If you're sitting there twiddling your thumbs, you're nervous, afraid to pull the trigger, looking for 5 million confluences, the move is going to miss you. You're going to join, and you're going to be a little late to the party, and then you're not going to get as much profit as you deserve. Okay. So real world example. Hmm. If SPY is trading at 500 and you buy a 500 call that expires this Friday for $2, that is a 200 per contract. If SPY rises $1 and your delta is 50, your contract gains $50 in value. That's leverage, small moves, amplified results, but remember, leverage magnifies gains and losses. So basically, to paraphrase this, it's just saying like if you was trading SPY today and you took a strike price of, I think we're in the 600s with SPY. Let me double check. I want to give you like a real good example. I'm gonna go over to the charts real quick. Let me see. All right, so SPY, she's down to 675. So let's say today you would have taken a strike price of 670 because we were a lot higher than that on SPY. We dropped $8.10 today, okay? So basically, the moment that you start to go in a correct direction, especially if you bought the strike price that was $200, if your delta was 0.50 cent, when we moved a dollar down, you would have gotten $50 in value. Okay. So again, with your contract today, if your delta said 0.50 and you bought the strike price that said $2, the moment that SPY moved $1 down, $50 was yours. The next moment it moved another dollar down, $50 was yours. So let's say SPY would have been like you would have gotten in at the optimal position today. We dropped a total of $8. If you would have gotten $50 per each one of those, one, two, three, $400 would have been yours, give or take, because yeah, you probably would have a little bit of it you might have given back to the market through decay over the day, or maybe not, because honestly, as long as you're in profit, you're good. The time that you start to theta starts to kick your butt is the moment you're out of profit. So if you would have timed it just right at market open, $400 yours, boom boom bam, thank you ma'am, close that sucker out around, I would say, before power hour. Close it out before power hour, honestly, because power hour, it may get a little bit of volatility. So 3 o'clock to the 4 o'clock, if you're in really good profit, take your profit. If you have multiple contracts, leave a runner, but don't leave your entire contract into the 3 o'clock hour, especially if you joined at the top of the day. All right. So every contract has a strike price and an expiration date. So your strike is your target level. Your expiration is your time limit. Now, let me tell you what we do wrong as newbies. We literally will go and choose a strike price that's the cheapest based off our account. I say we because that was me. Oh God, I was tripping. I was tripping. That's why SPX has clapped me. That's why QQQ has clapped me. IWM has clapped because I'll go, well, what's afford? Actually, not IWM, because IWM has in the monies that are definitely affordable. But Q's, SPY, and SPX, and definitely NDX, like I guess freaking millionaires trade her. I don't know if y'all have ever looked, but freaking like one strike price out, you got to pay 6 Dayao to for one contract. I'm like, oh, okay. Tell me that I'm not a part of the rich tivities without telling me I'm not a part of them. But anyways, when we're on the charts and we sit there and we choose our contract based off of you only want to put $20 in the market, but you trying to get a hundo, baby, that's where you finna mess yourself up. And your 20 is finna get 8, and then you're finna leave with 10, and you finna be pissed off. Then you're gonna do the market is against me. Oh my God. No, babe, it's just that you really never went online and educated yourself. You didn't read anything. You didn't ask Chat GPT. You didn't get a book off Amazon. You didn't do nothing. You was on hopes and vibes, my guy or girl. And so with that being said, that's why you got that contract, but you got clapped, and then you gave the market 10 because you were nowhere near where the price was about to go, which is why it's very important for you guys to understand levels. It is very important for you to understand fair value gaps, EMAs, all of these different things now. Support and resistance, supply and demand. You pick one and master that. Whether you want to do ICT concepts or smart money concepts or the strat, you get one of those and you ride that sucker. Do you understand? Because that's going to help you understand. Oh, hey, that's going to help you understand where you're supposed to be getting in. If you don't know where you're supposed to be getting in, you're doing yourself a disservice. And that's why in Risks to Riches, I do the levels every day. The levels are a guide. And a lot of people, the people who take me up on my levels, they write me back and say, Danny, thank you for that. I came out the market up 50, up 100. The people who don't still be messaging me talking about, Danny, I'm losing money. Babe, why? Why? Why are you losing money? You should be entering your strike price based off of where you know price is going. Where is liquidity sitting? Where are we retesting? Where did that fair value gap leave those orders behind that need to get filled? Where? If you're choosing a target price that's nowhere near that, you're doing yourself a disservice. Price is always looking for liquidity. Price is always looking to fill orders that were left behind. And your strike price needs to work around that. Understand? Understand. All right. So a premium is the price that you pay to control 100 shares. It's the cost for participation. Leverage allows you to profit from smaller moves, but it also increases the risk. A $2 premium can double fast or vanish just as quickly. Respect leverage and trade with defined risk. I don't be leveraging on no option. Not that I know of. I don't leverage on options. So I mean, y'all could always, but we gonna skedaddle past that. So in the money versus out the money. So in the money options already have real value. They're more stable and more expensive. Remember, I said NDX was charging $6,000 for an in the money, but the out the money are cheaper and riskier and you lose faster. Click, click, bam on SPX. Everybody want to be a SPX baddie, right? But you can't afford the SPX prices. So therefore, you get that out the money contract that's cheaper and riskier, basically really a lotto, but you lose value faster because the price jerks you around before it ever reached the strike price. And once you finally do get there, you've either A, exited your position because you lost over half of your contract and got spooked, or B, now you've only made profit of $5 when you possibly could have made more if you would have gotten something that was in the money. So when learning, focus on in the money and at the money, they move smoother and react at a predictable price. Okay. I want to let y'all know we only got 20 slides and I'm a really good reader and breaker downer, and y'all do have a quiz tonight, so I hope y'all paying attention. Focus on delta, theta, and vega. Delta measures the direction, theta measures time decay, and theta is the one that all of us, we don't like her. We don't like her, but you can like her if you know how to enter in your trades correctly. Vega measures sensitivity to volatility. These three Greeks explain 80% of options behavior. Master them before worrying about the rest. So what they want you to do, what you should do before you start trading is understanding delta, theta, and vega. And you can see those on your options chain, believe it or not. So price movement changes with delta, time passes, it activates theta, and volatility expanding boost vega. Okay. So time passing is the one that gets us the most. Today, also, we had volatility. So Vega also affected us the most. You guys need to really, like I said, go to Chat GPT, go to Google, go to Yahoo, type in Delta, Theta, and Vega. Explain this to me like I'm 5 years old and let it explain it to you. Okay, so options trading becomes more powerful when you combine it with structure. Inside the Trader Bay method, which is the method I developed, I use liquidity sweeps, fair value gaps, and structural shifts to choose my strike price zones. Options amplify precision when structure and timing and psychology align. At the money gives balance, risk, and reward. In the money is slower but safer. Out the money is cheaper and emotional. And my God, I know you guys in here have experienced some out the money contracts that made your heart fall out of your body. The moment that we had a crazy drawdown and now your contract wasn't but freaking $40 and you're down 25 and you're like, no, oh my God. And you're saying like, come on. Drop it like drop. And you're talking to the market like, girl, ain't nobody listen to you. I know y'all have felt that. If you haven't, I'm gonna be real and say oh boy. I'm gonna be real and say that I have felt it. Okay? So if you've never felt it, I have. All right, so timing and entries. I like to use the 12 hour, the 6 hour, the 4, the 1. Okay. It depends on how I'm feeling. Lately, I've been really focusing on 1 hour. Lately, I've been really focusing on 1 hour. Lately, I've been focusing on the 1 hour. Every now and again on SPX, I will go to the 4 hour because that's her bestie. That's her bestie. Understood? All right. So checking higher time frames for bias and lower ones for execution. I don't kiki kaka on the 1 minute. I don't. Or the 5 minute. Because me as a newbie trader, when I sit there and I watch a green and then a red and a green and a red and a green and a red and a green and a red, 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 green, I can't take that. My anxiety starts to peak. So for me, believe it or not, the 30 minute and the 1 hour work very well for me, okay? And on the 4 hour, when I do use the 4 hour or the 12 or the 6, I mark the high and the low, indicating when I should be entering my put or when I should be entering my call. And then I go back to the 1 hour. Okay. All right. So why traders blow accounts? Most traders lose from not from lack of knowledge, but lack of discipline. Baby, all of us, that's it. That's it. I want y'all to know that. You could learn all day long. You could be the smartest one. Oh my goodness. But it's really you. It's all your flaws are exposed as a trader. You will oversize on positions, overstay in your losses, overtrade from emotion because you're pissed off. And options really magnify mistakes, so structure and emotional control are key, which is why we were supposed to be reading Mastery of Self. We not gonna go there on how I got halfway through the book. We not gonna do me. Okay, okay. We just gonna start again next week when we start psychology boot camp. All right, all right. But other than that, basically that affects us the most. Okay, my loves, is lack of discipline. So I've heard people say that when they start working out in the morning, having a routine of how they do their day every single day, or their morning or their night, that their trading got better. So this is why I created 21 Days of Green. It was supposed to challenge us to do 21 days of green trading, 21 days of eating green, living green, being outside more, working out, etc. Because if we can kind of structure and have those routines there, we will start to have discipline, and that discipline will show up in our accounts and in our trading. So, Trader Bay risk formula. Yeah. One trade equals one story. Every trade must have a clear beginning, middle, and end, an entry, a stop, and a target. If you can't tell the story in one sentence, then your trade ain't ready. Protect your capital. Every single time that I'm going into a trade, I narrate to you guys when we're in live trading, or to myself why I'm going in that trade. And baby, if it don't make sense, then it don't make dollars, and then I don't do it. And I had to learn that the hard way. My first 3 months, I was in there, hopes and dreams, okay? Hopes and dreams. I was like, I'm gonna enter because we melting up. And that literally exposes who can really trade and who can't. And baby, hey, spotlight was on me. I was out here looking crazy at times. Sometimes joining in on a melt was great. 50% of the time it was horrible. Okay. So what I will do is I'll say, all right, so I see there's sell side liquidity down here at this, 25,200. I see that we're up here on a failed two, and I know that price a failed two is like a failed two up, for the strat. Price is looking to reach this liquidity, so I'm gonna go ahead and short the market. I'm gonna put a trailing stop in, and I'm gonna hit these levels where we've rejected before. Every time I hit one of these levels, I will see, if I'm going to exit, or if we could potentially reverse. Or if I have multiple contracts, I'm going to exit these contracts. But I know that liquidity on NASDAQ is sitting here. So over on QQQ, liquidity is sitting, right there. Da, 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 da. This is where I'm aiming for. So I'm going to enter here. My stop loss is $1 above this, but I'm targeting down there. You need to be able to do that for every trade. If you can't, you shouldn't be trading, honestly. All right. Premium moves fast. Your piece must be slower. Detach from greed and fear. Trade structure and not emotion. Calm execution leads to consistent performance. If you are an herbalist, a holistic girly, a crunchy mama like myself, I would suggest that you get into drinking chamomile tea with honey at market open. If you feel physiological changes when you are trading and your heart starts to race and things get like, when I need you to drink chamomile tea. I would love for you to listen to lo-fi music, or I would love for you to listen to meditation music, R&B, okay, smooth music, classical music. I would love for you to be in a relaxed environment. Put your essential oil diffuser and put lavender inside of it, or put lavender on your wrist and wrist. That's crazy. Wrist and behind your ears, okay? You got to get into the what we call dialectical behavioral therapy in the psychology world, where you have all of the things that keep you grounded and in the moment and keep you peaceful. And it focuses on your five senses. We're going to talk about this in Psychology Boot Camp, and that's free. So I hope I'm going to see you there. I won't spend all my time there tonight, but again, it's called dialectical behavioral therapy. Okay. All right. So the market is a mirror. It's always reflecting your mindset. If you fear you're going to miss out, you'll chase. If you fear loss, you'll exit too soon. Every reaction is feedback, and the chart mirrors your growth. Okay. So the mantra for the week is I master my emotions before I master my strike. When you lead with emotional balance, you trade from clarity and not chaos. I really want to hark on that, and we're going to go back to it in just a second. So we do have homework, and I am going to, this ain't the homework. Oh, okay. No, this is the homework. We do have homework. You're going to pick a ticker, and you're going to go in there, and I need you to screenshot what is an in the money strike price and at the money. Wait, in the money? Is it at the money and out the money? I always mix these up. I think that's what I mean. Yes, 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 yes. I need you to show me the three. So literally, I'm looking for you to be able to identify on, let's say, SPX or SPY, like where is that target? Like where current price is currently. I need you to show me that. That one is like right there on the money. There on the money, okay? And then I need you to go maybe five, six strike prices out and look at those. Choose one, and that shows that you're a little bit out, a little further out. And then there's ones that are out of the money completely. And I need you to look at those too. And I want you to take a screenshot and like understand the difference between those and how far out you're putting yourself. And I should definitely make y'all do it on SPX, because honestly, that's the one that everybody be trying to trade and be looking crazy. So tonight, go to SPX, and I want you to look at the one that is like literally a strike price away. I want you to look about five to six strike prices away. Then I want you to look at 10 strike prices away. I want you to look at the price of it. I want you to look at the theta and oh Lord, I don't know why, but it just left my mind. Theta and them girls, the Greeks. I want you to look at those for each one of those strike price. You're gonna choose three. I want you to look at the Greeks, and I want you to drop it into the homework tab, please. This is going to benefit you, okay? All right. And then write down why this doesn't fit your bias. So what it means is write down why this wouldn't be a good move for you. To like if you look at one that's way out the money, like it's SPX, $10 out, $20 out, why isn't this a good move? Based off of the Greeks and looking at everything that you see and the volume on it, etc. Is it why should I not do this? Okay. Same thing for the other ones, but I'm pretty sure the closer you get to strike price, you're not gonna have a reason why it doesn't fit your bias. You're gonna have a reason why it does fit your bias. Okay. Let me look here. Okay, so thank you for joining Intro to Options with Trader Bay. Remember, trading's not about perfection, it's about awareness. Trade consciously, heal intentionally, and then you profit from peace. Okay, now we're not done. I want you guys, Kate, I sure can. I want you guys to oh, I'm going to upload this, my love, as well. But I want you guys to ask me questions. What or tell me what has been the hardest thing for you this week? I literally have 10 minutes, and I'm pretty sure things that you're going to tell me because this episode is actually going to be put into my podcast show. And it's also going to be on YouTube. But things that you tell me are things that other people are struggling with. So I'm going to start. When it comes to options, I struggle with zero DTEs. I do the best work when I have all week to be in my trade. I have done my best work, 300% each time on gold when I was swinging gold from week to week or whatever the case is. When I swung SPX, I did a call for her because buyers were really stepping in heavy in power hour the previous day. So I swung a call for the next day. And when I came into the market, I came into like $250 off rip right there at the beginning of market. And it's funny because market continued to go up a little bit. I probably could have gotten even more money, but and so I say that to say I struggle with zero DTEs because it's just that time eating, and going against my contract and me understanding like when to get in, etc. I am a person that will overanalyze the charts as well. I do good now, but I'm just having a green streak now. Psh, like I'm not on my high horse, okay? So like I know my analysis and my statistical things and all of that, but next week might clap me, who knows? And so one of the things that I struggle with as a trader is literally just like being comfortable with entering off my initial move. I love for like to see a couple of things like, oh, well, if we touch this strike price and it has this type of candle and I'm standing on one foot and the sun is up at a 12-degree angle and then and then and then I had McDonald's for breakfast and I did my part to the right side of my head, then this is going to be a good trade. By the time I've put all those things together, it's like, girl, what? And then the move is made. The move is made and it's done. Everybody else is like, whoa, did you see that? And here I am, like, nah, man, I got left behind. So I created Trader Bay method to be a very, very simple. And sometimes, because Trader Bay method is new to me, but these are the days that I've done really great in the market, sometimes I forget to use Trader Bay method and I'll revert back to my old self and I'll be out there just over analyzing the heck out of a chart. And I have to go, no, 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 no. Support and resistance. Higher time frame. What's going on? Time frame continuity. What's going on? Where is liquidity sitting? Fair value gaps. Okay, bring it back, bring it back. And then it works well for me. So those are things that I struggle with. Is there anything that you guys struggle with or have any questions about before I drop this quiz and this homework that all nine of y'all better do? I don't care if you already know about it. I want to see y'all make some hundreds. I might send you a little Starbucks gift card. I think I should, honestly. Get a little, a little pink drink, a little coffee on me, okay? So I need to see, y'all do y'all's work. Getting out when you're green. Trusting, yes, Steph, that's a tough one. Getting out when you're green is very, very important. But it's funny because the market typically will give you a little bit more green, right? So the times that you didn't get out when you were green, it probably reversed on you. But then the times when you did stay, it did something like it always does the opposite. So sometimes the best thing to do is to get two contracts. Get two so that you can lock in that one green and maybe leave a runner, or know that we've hit that liquidity or we've hit the 50% of that fair value gap or the top or the bottom of the fair value gap support or resistance, and that now it is time to go ahead and take that profit because we're about to reverse. So I definitely understand getting out when green. I hesitate staying in trades longer because I think I'll hit bigger instead of taking profit. Peach, me too. Me too. God, can we use this knowledge with futures? Yes, we can. And I'm going to cover some of the same stuff tomorrow night, but for a little longer. It's crazy. How do you choose the best premium and strike price? Now, Jada, we got to talk about that because I literally got 10 minutes. So I will literally do a whole podcast episode for you. I got you, girl. I got you. I got you. And let me see who else. I'm also going to answer Peach's questions on hesitating and staying in trades longer because thinking of bigger profit. So we're going to hit copy, we're going to hit paste, and then we're going to do Jada. And then I'm going to create these into a podcast episode just for y'all. There we go. Perfect. All right, guys, I love you. I'll have, okay, analysis paralysis. Let me get this too. Analysis, okay. I love you guys. I don't want to lose you or like it cuts us off. So I'm going to let y'all go. Have a blessed night. This will be uploaded to YouTube and to the podcast show. I will see you guys soon. Okay, it's Riri. Oh, okay, all right. I love y'all. Thank you so much for supporting the Discord and everything. And I got you guys, okay? Homework tonight, quiz tonight. I'm uploading it right after class, all right? See y'all later. Okay. Boom.